Today we are going to discuss a topic of paper F1, that is how to calculate capital gain tax, that is CGT. First of all, let me discuss the definition of capital gain. A capital gain is a chargeable disposal of a chargeable asset by a chargeable person. Now let's discuss the definition. First of all, what is chargeable disposal? What is chargeable asset? And what is chargeable person? Disposal in normal case is the selling of an asset. Chargeable asset means it is not an exempt asset. In UK, there are few assets that are classified as exempt assets. And chargeable person might be an individual or a company. Means an individual is selling an asset and getting some gain out of it, or a company is selling an asset and getting gain out of it. So an individual or a company has to pay corporate gain has to pay capital gain tax on that. Now let's move to the computation of CGT. First of all, let me just give you a format for that. In order to calculate the capital gain tax, first of all, you have to identify the disposal proceed, that is the selling price. Then you have to deduct the selling cost of producing this proceed, and this is the net selling price. This selling cost is an allowable expense by tax authority. And then from this net selling price, the allowable cost of purchase, and if there is any additional cost, so deduct all the cost of purchase and additional cost. If there is a gain as a result of this, then it will be called as unindexed gain. And then tax authority allows the indexation allowance to be deducted against this gain. Remember that this indexation allowance is only available when there is a gain. If there is a loss, so no indexation is available. So after deducting this indexation allowance, the amount that will become that will be the as a result of that indexation allowance is your taxable gain. Usually there is an exemption available for an individual, but in our syllabus this exemption is not available. So unindexed gain, deduct indexation allowance, the remaining balance is taxable gain. Apply tax rate assuming 20%, and this will be your capital gain tax liability. Let's solve an example. For example, selling price of an asset is 2,40,000. Selling cost is 10,000. Disposal held on 1st January 2016. The asset was purchased at a cost of 1,80,000 on 1st January 2015. At the time of purchase of assets, the retail price index was 120, and at the time of sale, the retail price index was 128. We use retail price index to calculate the indexation allowance. Indexation allowance can be calculated through a formula, that is cost multiplied by indexation factor. And that indexation factor can be calculated through retail price index at disposal minus retail price at acquisition over retail price at acquisition. This will provide you an indexation factors, and you can calculate the indexation allowance. In this example, the retail price index was 128 at disposal date, and at acquisition that it was 120 divided by 120. This will give you an indexation factor. If you multiply this with the cost of the asset, that is 1,80,000. So